and I am your host for today's Masterclass session. On behalf of NESCOM COE DSMAI, I welcome you all and hope everyone is staying safe and keeping the spirits high. So before we start the session, I request all the participants to keep their microphones on mute and switch off their videos. Please type your questions in the chat box and we will respond to those during the Q&A session. Moreover, please fill up the feedback survey form after the session. Thank you. So now on to the topic for today, stages and timings for fundraising. The journey of a startup to become a high-value business, or at times even a unicorn, starts with a well-developed approach to raise funds at opportune times and stages. So the key questions that arise are, what are the stages of funding and how timing is important in this context? To help us answer these questions, we have today with us Mr. Rajiv Vyas, the founder of RV&Associates, an investment bank based in Mumbai. And Rajiv will share his perspective on today's topic. After his MBA from Boston, US, Rajiv worked at Wall Street in various leadership roles for many years. He returned to India to work with Tata Group company IHC, where he headed the introduction of Pepsi in India. He rose to become the youngest director ever in Tata Group. During his stint at Tata's, he led several group companies ranging from manufacturing to FMCG. He then moved on to the world of finance, where he started with scaling up a small regional NBFC called GLFL to number 3 position nationwide. He also took up leadership role at Chapul G. Palonji Finance and steered the first ever securitization of future receivables. As the COO and CFO of Baron Industries, which are the makers of Akai TV, Iowa Sound Systems, and TCL range of products, Rajiv scaled the company from a rupees 150 crore revenue to rupees 900 crore in just 3 years. He was then invited by the Hinduja Group to lead its TMT business called Hinduja TMT, which was a $2 billion company at that time. During his tenure as the head of the company, he was appointed on the panel of experts by Information and Broadcasting Ministry to bring digitization of television distribution system. He successfully brought in the bill named as Cable Amendment Act, a bill passed unanimously by both houses of the parliament. This was the introduction of the set-top box for TV viewing in India. At Hinduja TMT, he also got Intel to invest $300 million and another Swiss technology encryption company, Kudelski, another 75 million. He then entered the entrepreneurial phase and took over a struggling content production company called Optimistics as a major stakeholder and its CEO. Over the next 2 years, he took the revenues of the company from 2 crores to 150 crores. He did all this while introducing the first Indian Idol show. His next role as the co-founder of another production company, he got the seed investment from top corporates like Tata Sons and Goldman Sachs. He also co-founded Scott, which was an aggregator combining the collective strength of all the cable TV distributors. This venture of his received $25 million as seed invest money from City Ventures and then was subsequently taken over by U Telecom, which was an invested company of City Ventures. Rajiv, it is fantastic to have you with us today in this masterclass session. Just to let you know that we have had a great response to this masterclass. So without further ado, let me open up the stage for you. Ladies and gentlemen, Mr. Rajiv Vyas.
Thank you very much, Madhav, for that very flattering introduction. Thank you, Snehanshu. Thank you, Supriya from the NESCOM team. I'm really grateful and very happy to be here. It's an honor to be in a room full of ideators, thinkers, and the future big businesses of India, I'm sure. In this, I think we are at a stage right now where this is possibly one of the best times to be in a startup stage. Pretty much the slate is clean. Big ideas are welcome. Disruptive ideas are going to rule the world. The way we did our business earlier and the way the businesses were conducted, there's going to be a paradigm shift in the way it is being done. So this is a very big opportunity, and all of you guys with new ideas, smart ideas, uh, capabilities, you are going to add to the India story, and it's really a pleasure to speak with you guys. So let me start with this. I think Mahatma Gandhi said, find purpose and means will follow. So my first thing, before we start on funding, we start on everything else. Uh, my first uh, note to you would be that follow your passion. I think the most important thing is that you must have the passion for your idea. You must believe in your idea. You must see through the idea. And I'm sure the means will follow, whether it's in terms of financial resources, whether it's in terms of market access, whether it's in terms of other factors which contribute to the success of your enterprise. And this, have the passion, have a goal in mind, and keep up to it. That's the main thing. Okay, so let's start at the beginning. Uh, what is a business idea? I mean, what is the idea that you have? How does it compare to what is available out there and different solutions that are available out there? How do you visualize your company? How do you do the business modeling uh, in terms of who are your partners? What's your USP? How have you identified your market segment? What channels will you deploy to get to the market that you've identified? Uh, what will be your pricing model? Uh, what will be your competitive strategy or SWOT analysis, as we call it, in this. So these are some of the things that you should have in your mind and ready when you're thinking of this as an idea and saying that, okay, I want to take this as a business idea. Key components of business ideas are what I just said, that this is a thought out business idea as opposed to a pie in the sky. Okay. Uh, well, when we're talking about businesses, uh, there are different stages, of course, of funding, and at every stage, businesses require funding. Uh, Part of it is from internal accruals, part of it is debt, part of it is equity, part of it is hybrid, etc. But normally, what we have seen, and I'm talking in the Indian context, especially here, is the pre-seed funding, which is where you're basically thinking through the idea and the ideation stage uh, in a more concrete way is your pre-seed uh, stage, as we call it. And that would be mainly through bootstrapping, which could be your own savings, could be from your family and friends, uh, could be from anywhere that you can think of. You could probably take a debt and bootstrap an idea as well. Your next stage would be seed capital, where you would be honing that idea and giving it shape, giving it certain concretion. We are going to talk a lot more about each of these stages during the presentation, so I'm not going to dwell on it too long, but these are the stages that we go through. So the second stage is the seed stage, where we have minimum viable product, which is product idea, project, whatever you want to call it, uh, which is ready. Once it is ready and it is in the market and it is established and it's working fine, we go to Series A, where the product market fits, revenue run rates are there, there is a track record uh, of, and it's an established business model. Subsequent to Series E, we go to Series B, where it is growth capital, where we are talking about an already established business which is doing extremely well, and it needs to grow into either into different market segments, different geographies, or different verticals, etc. Uh, Series C is typically your valuation driving uh, uh, funding round, where you are where you are excuse me where you are taking the funding to actually accelerate your business and hope, look for an exit. So the acceleration could be in terms of acquisition of uh, other companies. It could be in terms of enhancing the valuation of your company for a pre-IPO valuation, etc. So these are some of the stages of uh, in the life of funding life of a company. Pre-seed funding. Now, many startups use their own seed funding for the new company. As I said earlier, it is called bootstrapping. And this is mainly creating a basic setup for the launch of an initiative, company formation, patents, etc. Normally, at this point of time, what you would really have is what is called a Twitter pitch or an elevator pitch ready in hand. Twitter pitch is basically where you can articulate your idea in one sentence. That this is my idea, and you tell it to someone and say that I'm thinking of this as my idea, and this is your Twitter pitch. An elevator pitch is slightly more what do you call etched out idea, where it's a short description of the business idea. So it gives you a little more details about how you would go about doing it, etc. But these are the minimum readiness in terms of pre-seed funding I would look at. Post pre-seed, we would come to seed funding. Seed funding. What are the factors that we require that need to be in place for seed funding? One is, of course, as I said, there should be a compelling, well threshed out business idea. Organization tree with desired talent should be identified. Should have industry experts endorsements, and investment deck with projections, etc. should be ready. A complete business plan with which etches out the USP of the project, different milestones, projections, etc. is ready to be presented to the possible investors. Okay, I'm going to not talk too much over this slide, and just for your information, after this session is over, I will be handing over the slide to Madhav and team, and you will have access to this. If you find it of any value, you're most welcome to use it. So if I skip on certain points, don't worry about it. You will have an access. And okay, so seed funding, as it suggests, it's the analogy is the seed for a tree, that you plant a seed and a tree grows. And this is where you're looking at seed funding. With seed funding, a company, the seed funding is used by a company to determine its final product. Who will be its target demographic? Seed funding will be used to employ a founding team to complete the task, to make a minimum viable product. A well thought out business plan highlighting the USP with milestones and credibility of the team is very important. At this stage, the investor is betting as much on the founders as on a business plan. So the credibility of a entrepreneur in terms of presenting the idea is very, very important, as much as sometimes the idea itself. people are backing both almost on a 50-50 basis in this. So these are different options for your first seed funding, crowdfunding. Now, crowdfunding in India is fairly limited. It is limited by SEBI. Number of people that can participate in crowdfunding is about 200, with a range of about between 20 to 60,000 uh, per investor. Uh, Amol, you can jump in and correct me if I'm wrong. Uh, corporate, then you have corporate seed funds, which are like Microsoft, Amazon, Apple, Google, sorry, Google, Intel. Uh, then you have your incubators, you have different accelerators, you have angel investors, you have debt funding, uh, convertible securities, which are hybrid funds, venture capital funding, angel networks, and very well, it's not very prevalent right now in India, but cryptocurrency is another way of funding, which is finding flavor the world over. The ICOs, as it's called, they are getting highly popular, and there are several of them uh, which are very active in Singapore, Japan, South Korea, Hong Kong, etc. Sorry, what happened here? Okay. Uh, well, for basically any funding enterprise, uh, what you'd first need to do is find out the valuation for your company and what is it that you are ready to give to the investor, for the investor that invests into your company. So valuation exercise is very important. Normally at a seed stage, people give anywhere between 5% to 25%. Uh, Amol and I have seen various digressions to this as well.
Rajiv, we can't see the PPT.
Oh, you can't see the PPT?
Yeah.
Oh, okay, one second. I don't know what happened.
You're unable to do it?
Wait, I'm just give me a second.
Now we can see.
Okay. Is that okay now? Is that okay now?
Yeah.
Yes.
Yeah.
Okay. So I think it skipped a couple of. Okay. Valuations. So I was saying that basically it is between 5% to 25%. There are various exceptions. In fact, when we speak uh, further in the presentation, I'll give you a citing of example where we've diluted much more than that in one of the exercises where I was a co-founder in this. So there is no really a set valuation that you can do. It depends completely on your negotiating strength at that particular point of time and the market available to that idea. Uh, it can be just the flavor of the season where the investors are looking at particular industries to fund it, and you would be getting very favorable valuations. You may have a brilliant idea, and if it's not in flavor at that point of time, you might have to compromise in terms of valuation and structure it in a way that you can claw back your equity at a later stage. in this. Okay. Okay, I'll give you two examples of seed funding where I've been personally engaged in. One is an aggregate model that we did, and the second is a greenfield model that we did. So the first example, okay. Okay, the first example is basically of a company which we formed. This was in, I think, 2008, if I'm not mistaken. Am I correct, Amon? It is,
Yeah.
It was called SCOD. Sorry. It's called SCOD, Smart Cable Operators and Distributors. So we thought it was a very smart thing to do, and we named it as SCOD, SCOD 18. Basically, it was an aggregated model where different cable operators and distributors came together and formed a company, and they climbed up on the value chain. What gave seed to this idea or this company was a ruling from TRAI, which is the regulating body for the cable business, where they said that in the value chain, they would de-recognize the distributor from the value chain, and there would be broadcaster, there would be multi-system operator MSOs, and then there would be a cable operator, and then there would be a customer. So this was a value chain, and whatever was the pie, this was to be shared in a predetermined percentage and value across the chain. So they basically, what it did was that it removed the distributor completely from the value chain. And now, historically, the distributors were the people who actually created these businesses, and they were mini aggregators where several of the cable operators operated under them, and they in turn operated under MSO and so on. So what we did was I along with two others, we founded this squad, and we said that all the distributors will now form a cooperative which will become an MSO. So we climbed up one step on the value chain in this. So it was just only an idea. It was a 2-page idea, which was ready with us. We made a pitch to several venture capitalist firms. We went to everybody that we could think of at that point of time. And in about 3 to 4 months' time, we identified City Ventures who showed a lot of traction, and they really liked the idea that this was a game changer in this. So at that point of time, we engaged with a investment banking firm, and we got them to front us in terms of the negotiations. And earlier too, I've mentioned that, it's a very good idea when you have someone else negotiating for you. It gives you a lot more leeway in terms of decision making in this. So finally, we City Ventures agreed to put in $25 million where we diluted an equity of about 66%. Based on the preset milestones, if we reach those milestones, we could claw back the equity up to 49%. So we would have the majority of the company back in our hand if we were able to reach those milestones. However, if we were not able to do that, we would lose out and dilute our equity up to 74% in this. And City Ventures would have obviously overwhelming majority stake in that. This is completely performance related in this. But this goes back to what I was saying, that there is no set range or valuation that you can really look at, that the dilution of value should be between 5% to 25%, or it really depends on the opportunity. It depends on how desperate you are to do it, and how well you can structure it, that even if you give it back a little more in initial stages, can you claw back later through your performances? It depends on your confidence of the idea and your confidence of the enterprise that you are pitching to these people. Okay. Okay. The second example is, I think about 4 years later, where I set up a TV content production company, which is called Mandolin Sky uh, Entertainment Private Limited. And we got, the whole idea was that since I had the network and the contacts with the top broadcasters, that we would do the programming, and since we already had a legacy of creating very good content like Indian Idol, etc., having won a lot of awards, we would start another production company, which would be focusing on events and on talk shows and on ad films and movies, etc. This. So we started with the bootstrapping, and then we went to basically a family wealth advisor, and to pitch in for the idea. They liked the idea so much that they told all their clients, and their clients were basically people like who were on the board of Tata Sons, Goldman Sachs, India Head, a couple of other really marquee names. They bought into the idea, and we diluted. I mean, we just wanted 50 lakhs, which was to set up the company, and we diluted 20% and give them a board representation. When we did the projections, we were not relying. There were two things that we worked on, which was that we wanted to dilute as little as possible and take as little outside money as possible, because we wanted to create a business model which would be self-sustaining. So here what we did was that we worked on a hybrid of equity as well as debt. So while the equity funded the initial setup and everything, once a product was made and we had, for instance, a episode was made and it was presented as a bill to the broadcaster, we went to the bank and we did bill discounting. So that helped us in terms of working capital, and we didn't need to take extra money from people and dilute our equity. We scaled up the company to a very large extent, and at one point of time, we bought back all the stakeholders, gave them 18% as return, and bought back the full equity, and sold this company off to other investors. So again, I've given you two examples, which one falls within the range and the other one which is way off the range, but we could claw back that. Okay. What are the ways of valuation? What are the methods of valuation? One is obviously cost to duplicate. I mean, it's very obvious when we say what is cost to duplication, because really the cost of setting up a similar enterprise, what would it cost? And if you're able to, the investor would value your company at little lesser than what it would obviously cost to set up a similar enterprise. Here, the credibility of the people who are actually doing this would be the key, because there is already a successful business which is running, and what you're doing is you're either improving upon it, or your value proposition is that you're improving upon the present condition or creating efficiencies, and for which the credibility of the founder is very, very, very important in this. So cost to duplication is self-explanatory to a large extent, I think. And DCF. So most of you, I'm sure, I mean, all of you know, been through discounted cash flow methods, and I think it's important to recognize that on Excel, everybody can make $1 billion business. So one can get carried away with the projections very easily. The idea is to create three different projections, which is optimistic, realistic, and a pessimistic scenario. And somewhere along the line, you'll find objectivity in terms of the projections that you are doing. Normally, your projection should be based on a 5 to 7 years horizon. I don't think people can see beyond 5 to 7 years horizon how the business world is going to change. And in current times, that we really don't know in next 1 year how the horizons are going to change. So the predictions need to be very compact, very reasoned. There must be a very solid basis on which the numbers are being presented. There has to be a story that needs to be justified, which is verifiable with facts. So DCF is another one with, and all your financial guys will be able to tell you that it's basically what you're doing is that you're taking the earnings over the next future earnings and presenting it to a net present value and saying that this is the enterprise value of the company, and based on this, the dilution is agreed upon, and I mean negotiated upon rather, and so that's a valuation method. The third method that is also used is market multiple. Very often we have seen in the recent past, there have been companies which have worked more on burn model to acquire market shares. So like Paytm, Ola, Flipkart, etc. I mean, they've been in business for, I think, a few years, and yet they haven't shown profit, and the losses are there. But we keep seeing investors coming in and putting in more and more money. And the reason is that they are seen as basically a marketing cost, that this is the money that you're pouring it to acquire a certain amount of market. And so depending on the penetration that you are able to achieve, the revenues that you're able to achieve, you negotiate on the basis of multiples of those values. So these are some of there are many other methods of valuation of enterprises, but these are some of those set methods. These are the normal methods in which people look at valuations of company. Okay, so next is your Series A. By Series A, you will have, By Series A, you will have your established business model, which is running well. It has achieved a good run rate, track record, established a good user base, has a consistent revenue figures, and it's met with the key performance indices. Sorry, I just got distracted by a chat there. At this stage, which is, it again depends, it differs from businesses to businesses, but normally I would say anywhere between a year and a half, 2 years from seed funding, you should be looking at Series A funding in order to optimize your user base, better your product offering, scale up the products, reach different markets, etc. So Series A funding, people are not really looking at purely at ideas. They are looking at businesses now. That yes, there is a good idea, but is it a successful business? Is there a traction in the idea that you have proposed? Is it a strong, viable future, if not present, in future money-making business in this? So, so this is the time when you're looking at Series A funding. Series A funding rounds are basically your investors are well-known capital firm venture funds, uh, Sequoia, Nexus, Intel, uh, Capital, ICICI Ventures, Safe Partners, etc. I mean, these are all of the established ones, and I'm sure if you engage with good investment banks, there are probably 30, 40 others which are available in this. Uh, and a lot of this Series A investors are sector specific. There are some which are sector agnostic, and there are some which are very sector specific in this. And if I actually may rewind back to seed funding, for instance, even in seed funding, there are some seed funding agencies which only seed fund, for instance, AI. Uh, there's a organization called Z Nation. I don't know if you guys have heard of it or not. Anyway, I'll share that with Madhav at a later stage. They are seed funders, and they look at purely at AI ventures in this. So even there, you could look at certain sector specific seed funds. Similarly here, there'll be some which will be sector agnostic, some will be sector specific. So in Series A, I think it's very important to engage with a very good investment bank, because at this point of time, the big money is flowing in, and in absence of the market knowledge, when I say market knowledge as in market intelligence, one can dilute too much of equity also if one is not aware of what the landscape, investment landscape which is available. And that's where the value addition of good investment bank comes in. They will identify a good anchor investor. They will bring in others based on the anchor investors. There'll be a good funding strategy that will be there. All of this is required so that the founders and the present team, which is running the business, is focused on scaling up the business and is not diverting its energy towards finding another source of funding all over again in this. So most of the places I think in virtually all of the Series A funding that I've been associated with, we have worked with investment banks, and with very, very good results. So it's very, in India, investment banking firms traditionally have worked on success fee basis. Internationally, they work on retainership basis with success fee as a so in India it is still there are a lot of companies which will work on a success basis. So it's a risk-free model to engage with. Risk-free slightly. Of course, we spend a lot of time and energy engaging with investment companies as well. So you need to identify good ones with track records, and especially the ones which have successfully got funding in the sectors that you guys are working in. One thing that we have to recognize is that between the seed funding and Series A, there is a drop of 50%. 50% of the companies that we who get seed funding don't even make it to Series A. So again, I cannot overemphasize the importance of a really good business plan, a sound business plan, and a good talent team to make sure that you scale up. Okay, I'll give you another example of a Series A. When I was CEO of Hinduja TMT, we were working on in cable, which is the cable business. We were working on traditional analog technology, and the signals were carried through copper wire, where at every junction, I mean, at a very short interval, we needed to, put in more equipment to actually uplift the signal so that it could reach the homes in this. So there was a tremendous amount of signal loss, and also the number of channels that it could carry was very, very limited. I think it was about 56, if I'm not mistaken, in this. So we wanted to upgrade our complete network to digital cable, optic fibers. And we, of course, needed funding, and we didn't have internal accruals to do it, and the promoters were not ready to put in additional capital from their side. So we went hunting for Series A funding, and we were able to convince Intel to invest $300 million in cable for a very, very small dilution. Which was for basically digitization of the network. Subsequently, I think about 2 years later, I again did another round of funding, again for technology, for buying the encryption system. Again, we didn't have too much money in hand, and we didn't want to spend what we had in terms of accrual. So we negotiated equity for technology and deal. We got in $75 million worth of equipment, encryption software, etc., and hardware. Sorry. Series B is basically growth capital. Series B is basically taking it to the next level. The investors who have worked with Series A are probably will put in another round of money to take it to the next level of growth. Series B fund. I'm sorry. Excuse me 1 second. Let me just. Okay. Companies that have gone through seed A funding rounds have already deployed substantial user base and have proven to investors that they are prepared for success on larger scale. Series B is used to grow the company so that it can meet with those levels of demands, that it has created a latent demand or it is not able to reach the demand, it is reaching that. It is also about building a substantial team. I think when you're at Series B level, you're looking at acquiring some serious talent, and talent doesn't come in cheap. So you're looking at funding to do that, business development, sales, advertising, tech support, employees, marketing costs. In case you are in the burn model, then you're looking at deep discounts again, like Paytm, others, which will further fuel your growth. Series B is normally led by the same number of people who are in series. Sorry, I don't know what is. Are you able to see the?
No, Rajiv. Your PPT we can't see.
Oh God. Sorry.
That's okay, Rajiv. We can continue without sharing the screen. That would be okay with us.
Sorry. One second. Let me just give me 1 second. Amol, can you have the same view? Go to series B now. आगे. Can you move one slide over? I think we've covered this, right? Amol?
Yeah, Rajiv, this is after this. This is what I have.
Oh. Okay, so move to the next one.
This one you completed.
Yeah.
Okay.
Sorry, folks. Can you scroll down, Amol?
Further.
Yeah. Slide 20.
This is all I have, Rajiv. Slide 20. This is what is slide 20.
Okay, I can't see it here. Can you take out just this part? Amol, can you just read through? I can't read the. I'm having problem with my.
Oh, this is series C. I mean, you were talking about series B, right?
Yeah.
Yeah. So, so series C or so on and so forth, must have, most of the people must have also read series C, D, E, a lot of, sort of these, numbers. But essentially, these are sort of funding rounds that happen when you have already not only established, I would say, a strong revenue stream and all, but pretty reasonable market position. And you can clearly see path to either an IPO or kind of merging multiple businesses. So whether it is a 3-year 5-year path to IPO, that lot of it depends on how the capital markets are. So the follow-on rounds will be series C, series D, series E. They kind of grow large in case, but I think more than the numbers, this in terms of the appetite of investors, this is a funding which is now focused entirely on growth, whether it is expansion into new markets or sort of creating a dominant position in the existing market. Some of the money can also be used for acquiring, whether it's a smaller startups or competitors. But so there is no this thing, you can have multiple such rounds before you sort of go into a public listing. So also the kind of investors, some of them would come into these series is you may get a lot of hedge fund, a lot of investors who are also playing into sort of listed markets, would be also looking at Series C investment? There you are, Rajiv.
Sorry.
Okay.
No, you continue. I will.
Okay. So a lot of them are, those kind of investors who, who are also would be there into, into the Series C. And essentially they look at sort of a lot of public markets, or potentially how are the competitors doing in public markets, to also benchmark investment. The benefit for the larger investors is that they can get into positions into some of these businesses before it actually goes into public market. So that way they are always getting some sort of a premium to the public markets. And obviously getting a good investor, say Goldman Sachs, or some other like a good hedge fund coming into it, obviously also helps with eventual distribution of for the public market. So many times you go for a listing, investment bankers would advise a company to get in some investors on board, which will eventually help into the listing. So I guess that covers all the different sort of series. Maybe it's a good idea to now open up for questions that you guys may have. And I don't know, Madhav, you're going to
Yes.
sort of
So
moderate the questions, or how it is?
I'm going to moderate the questions now. So we have, so thank you, Rajiv and Amol, for this insightful and refreshing session. So we are now taking the questions from the attendees. I just wanted to introduce Amol, who's a Cornell graduate and a CA. So Amol is also an M&A fundraising advisor. So his focus is on technology, media, telecom sectors. He's worked across online services, payments, software production, ITES also, worked both in US, India. He's worked with Deloitte, EY, Cypher Capital, Ask Raymond Jones. So he's also created a customer management product suite for institutional equities and investment banks. So with this in mind, the first question that we have is from Mr. Mohanty, who asked that, what are the best ways to navigate through the conflict arising out of the valuation?
What kind of conflicts? Can you elaborate a little bit?
Difference in valuation. So Mr. Mohanty says, so what are the ways that we can get out of or to break the deadlock when it comes to the conflict regarding the valuation? So somebody says like 20 million, the other one says 25 million, something like that.
Okay, I would go for a 2 or a 3 stage process in that. First of all is to reiterate the business plan and justify the projections that you have done that through hard data, that how the projections are going to pan out and how the value of the company is justified in the quantum that you are negotiating. So hopefully that should work. If that doesn't, then you negotiate with the investor or look at an alternative and keep that on a hold and look at an alternative investor. If that is not an option, then the third option for you is to structure it in a way that even if you give the equity, give a little bit more equity at the present time, where the investor holds the shorts, at later point of time, you should be able to claw back that equity. So if you are confident in your business model, in your performance, and in your team, then you should be able to negotiate. Even if you give that equity at this point of time, suppose he's asking for something which you feel is undervaluing your business, take the money. I think it is important to take the money when it is available. That's been my experience. Take the money and set in conditions that allow you to claw back your valuation to your desired levels. So put in performance parameters, put in your put in your money where your mouth is, essentially. So I would look at these as primary ways of looking at it. Amol, you want to jump in?
Yeah, I wanted to actually make it, I'll give you an example because this is something that just came into my mind. So I have he's a very good friend of mine and he's a very good chef. So he was raising money from some individual investors. Now, when I kind of got involved, they had a major difference. So my friend said, I am the top best chef in the country. There's nobody can be better than me. So I have decided the valuation for my restaurant chain is going to be 24 crores. Just take a number, whatever. And the investor was a very sophisticated investor, and he's like, well, justify it to me, right? He's like, I think it should be maybe 1/4 of that, but I have no logic. So when I actually met them, I looked at it and I realized there is no way this gap is going to be ever going to be sort of bridged until people start seeing things correctly. So I asked the investor, okay, what is your concern? His concern is, boss, my money is on the line, I might lose all my money, right? I asked my friend, what is your concern? He says, look, I don't want to get at too low valuation diluted because I have multiple rounds of investment coming in. I'll need more investors. So, if it starts happening, I will lose interest. Essentially, what we then decided is, I said, look, it's going to be your word versus the promoter's word. Why don't we do one thing? Why don't we create a convertible instrument, and we will basically look at the valuation will be decided when an institutional investor comes in who follows some methodology, whether it is a DCF or whatever structured way of methodology. And upon that, them coming in, we will convert your equity to say a 30 to 40% sort of a lower value to the institutional investors, right? Whatever, 30, 40, 50%, that depends on the timing. And oftentimes it is important to also know that what are the concerns that the investors have and what are the concerns that the founders have. And there are always multiple set of instruments that will help you bridge the gap where everyone's objective is met. So a lot of times when I talk to founders, they get hung up too much on the valuation number, not knowing that it's really not that important. If you have the right instrument, you can actually manage everything. You can make the investor happy, you can make the promoter happy, and ultimately everybody benefits.
Okay.
Great. Thank you, Amol and Rajiv. So one more question. We just have left time for one more question. So it's Rohit Phillips.
Sorry, Madhav, if there are questions, we are happy to answer them. Don't worry.
Great. So that would be great. So what we'll do is that we just have time for one more question as of now, but we will take all these questions, send you the email along popping with the people who have asked these questions, and then take it offline. Would that be okay with you?
Yeah, sure. I mean, we can extend by 15 minutes if you like. Okay, let's move to the next question.
So Rohit Phillips, he asks, what is a good pitch presentation for a non-profit? So, and he also seeks advice. So what are the avenues we could raise and seek funds?
Well, a good pitch presentation for a non-profit, it really depends on what is the agenda actually, and who are the people you would pitch it to. There are various non-profit organizations that themselves invest into it. There are CSR activities. There are that the corporates fund. Those would be good ones to go to. There could be also crowdfunding, which can help in terms of non-profit. There are various ways. The question is too broad to really give us a specific answer.
Okay. So we have another question from Ashish Kimtani, who says, do Indian seed investors consider safe notes, or do they mostly prefer equity?
Sorry, can you repeat that, please?
Yes. Do the Indian seed investors consider safe notes, or do they mostly prefer equity?
So I can answer that question. Okay. See, the thing is that most investors in general would prefer something which is a convertible kind of an instrument, which is not direct equity. And the reason is there are various legal reasons for that. Okay. Without getting into too much of the legalese, it essentially means that, you don't convert your equity, keep it as debt.
And the tax structure as well.
it gives you an advantage over equity holders in case of liquidation of company and or so on and so forth, and you can also manage a lot of rights.
As also the tax structure.
Yeah, and so there are lots of reasons why, from an investor point of view, a convertible is there. With direct equity is actually not, you don't really get advantages of all that. And anyway, since you have a shareholders agreement, you anyways have all the rights that you need, so you can get all the rights of equity as well as the benefits of debt.
Okay. Thank you so much, Amol. Thank you. So once again, Rajiv and Amol, thank you so much for taking out time to share your perspectives and answering a couple of questions. So we, as and when we are getting more questions, we are noting it down and we'll send the email to you, both of you, along with copying the person who has asked the question. So this way we can get connected to you directly. So, and I also thank all the participants for attending this session, and we look forward to your future participations. So thank you very much. Thank you, everyone. Thank you for your time. Stay safe.
Thanks Madhav. Thanks everyone.
Thank you.